Let's calculate the target prices and gross potential for Magnificent 7 stocks using the DCF valuation model or discounted cash flow model. As you see, I've prepared the list of 7 stocks. These are largest based on market cap, most popular stocks that are mentioned a lot in social media recently, especially due to the recent financial reports. And let's calculate those stocks' gross potential using the DCF valuation model. As you can see, I've already inputted the Apple share and it shows the 13% decline potential based on DCF valuation model. These are my assumptions and this is the main model. And then I have the second screen with inputs where I extract the data. For extracting data, we will need the Google Sheets and Financial Modeling Prep API key. First, you need to connect the Financial Modeling Prep with Google Sheets and then obtain the Financial Modeling Prep custom key, which you're going to use to extract the data. I will put the instructions down to this video on how to get the API key and how to connect Google Sheets with Financial Modeling Prep. Then you are good to go. I also will share the articles on how to calculate the stock target price with the DCF model. And at the end of the video, I will share one very simple application that will show you how you can calculate your stock gross potential as well. But first, let's calculate everything in in Google Sheets. So the next time you can build it yourself, and the next time you just have to change the stock ticker over here and it will calculate the stock target price based on the DCF model. Well, first I would need the formula after you connect the Financial Modeling Prep with Google Sheets. Just use this formula equals FMP Advanced DCF A1. So A1 is the cell with the stock ticker. And once you enter this formula, it will extract you the data needed for calculating the stock target price with DCF or discounted cash flow model. As you see, there is the forecasts till the year 2029. And this is our main model. So basically for discount rate or weighted average cost of capital, sometimes analysts call it like this. That's the weighted average cost that the company is bidding on its attracted funds, both equity and debt. In our case, it's 982. As you see, that's the average of inputs AI4, AI13. I'm extracting it from here. This is extracted with the FMP. You don't have to do anything here. Just take the average number of here. Once you input the formula, just in empty cell, input this formula, and you will get this entire table extracted for you. Then the next step would be just to take the averages, and it will be the discount rate. The next one is the perpetual growth rate or the long-term growth rate. As you can see, it's also from here, cell AN4. The long-term company growth rate is expected at 4% yearly. And then the earnings before interest and tax is this number, 183 billion, as also extracted from the inputs. This one is also, which is simply depreciation divided by earnings before interest and tax. Depreciation is taken from here, from this cell, as you can see. And then we take the enterprise value EBITDA. Enterprise value is the total company's value, and EBITDA is the sales in the simple terms. In this case, it's showing us 15. The lower the value, the better it is, especially if you compare it to the closest peers. It is telling that the Apple needs 15 years of sales to reach its total company value. But for example, if the value is 3, it means that the company is generating a lot of sales and it would need only 3 years to reach the company's total value. So the transaction date, let's assume we're buying the stock today and we want to see the stock's value as of today. The fiscal year end for Apple shares, the year ends on the 13th of September 2026. And for each stock, you need to make those corrections to reflect this model accurately. But for this video, I'm not touching this number just to make everything simple and fast. But you need to correct for each stock. For example, some stocks have the financial year ending in 31st of December, some have in June, some have in September, and I'm reflecting that each year Apple's financial year ends on 13th of September. Then we have the current share price. It's also extracted from the inputs. You would need this formula. Simply go to the empty cell or just do as me, A17 cell, and put this formula equals FMP real-time price. Again, A4 because this is the stock ticker. Hit enter and it will extract you the live share price of the Microsoft, which is as of today, as of the moment for recording this video, is 222.01. Then you need the shares outstanding, which I've also taken from here. Yes, deleted shares outstanding. And we take the total debt and company's cash. They are also extracted AD9. You can see from inputs AD9. This is the total debt and cash I have extracted the same way. The next thing to do is to extrapolate everything till the year 2029. Let's say we are making forecast for 5 years in advance. And then each year ends on the 13th of September, as I have mentioned previously. Time periods, of course, we are forecasting 4 years in advance. The year fraction, it means that till the next reporting period is 0.91, is like the percentage of how much time left till the year ends. There is 100 because the year haven't started yet. And then we take the free cash flow. I take the first free cash flow AU8 from the inputs over here, the last row. I take the company's free cash flow for the year 2025. And then I forecast the free cash flow for the remaining years. Now, if you see the formula, I am thinking that the free cash flow will be growing at the pace of 5% each year. For each year, I am putting the 5% free cash flow growth rate. If it's a larger company like Apple, usually the 5% is okay, but if it's a smaller company or the company from the smaller market cap, then you can take the higher growth rate like 10, 15, or even 20% if it's very small company, because it can have better free cash flow surprises. Then what I do, I basically discount the free cash flow by the WACC, or the weighted average cost of capital, and I get the discounted cash flows for each year. The next thing is to calculate the company's terminal value, which is basically the average of those two calculations, the perpetual growth rate and enterprise value EBITDA. And you can double click on here and you see the formula, which is basically the free cash flow for the last forecasted year. In our case, it's a 2029, multiplied by 1 plus the perpetual growth rate divided by the perpetual growth rate minus plus the perpetual growth rate. Discounted rate minus plus the perpetual growth rate. Plus here in case if it's a negative number, so that to make it deductible over here in this formula, I make this formula. But you can simply copy this formula from here to calculate this data. Now we calculate the enterprise value EBITDA. The formula is also given. You take the enterprise value and multiply it by the last year EBIT, plus EBIT multiplied by the percentage depreciation from the earnings before interest and tax. These are our assumptions. We extracted everything using the FMP's data point. As you can see from the inputs, just simply extract everything from here, extract this free cash flow number, and make your assumption on free cash flow growth rate for each year, and you're good to go. The rest would be calculated by the formulas. Simply you can copy those formulas and see the logic of how these formulas are calculated. I'm not diving deep into this, just not to make this video too long. Simply these are the formulas. You can copy those formulas, then extract the average, and you get the terminal value. The next step is the intrinsic value. This is the enterprise value of the company, which is the forecasted total value of the company. As you see, we've made a forecast till the year 2029. Then you add the cash to it minus debt, and you get the equity value, which is simply the market cap, the forecasted market cap, company's market cap. And you divide it by the number of shares outstanding, which is here, 15 billion. And you get the equity value or the forecasted stock price that is calculated using the DCF or discounted cash flow model. The next step is to make simple comparisons of the market value. The current share price is 222 and our calculated value is 193. So it means that it has the 28% decline potential, or in percentage term, Apple has the 13% decline potential, which means that based on this DCF model with these our assumptions, Apple has 13% decline potential. These your assumptions. You can change those assumptions if you think that in the future the cost of money will be higher. You can increase this number, but the probability for high cost of money is low because the Fed is going to lower interest rate further. That's why it's gonna be only slower, only a lower number. The perpetual growth rate, you can make it higher, especially for larger companies. For smaller companies, I'm sorry, this is entirely up to you what to put in here. This is your assumptions. And this is your complete model. You can copy the same logic from here as I did in my video. And now what we can do, we can try doing it for the similar stocks in the list. Simply replace Apple with Meta. Apple 13% decline potential. Then Meta has it's extracting everything, as you can see, 26% decline potential. Then you can see what's happening with Microsoft. As you can see, as soon as you change the stock ticker, the financial modeling prep is extracting your data, and this DCF model is changing as well. So the Meta has 23% upside potential if you imply 5% free cash flow growth rate and 8.3% weighted average cost of capital or discount rate. Then we have the Amazon shares, which has 68% decline potential. That means that it's heavily overvalued based on our DCF model. Then we have a Google shares with 23% growth potential, and we have the NVDA shares with 25% decline potential, and we have Tesla shares. Finally, the last stock among Magnificent 7 is 62% decline potential, but let's see how it will perform. I like that the Tesla is showing great free cash flow improvement, great free cash flow dynamics for the second quarter in a row. And based on our observation, only 2 companies among Magnificent 7 look overvalued. This is Microsoft, I think. Yeah, with 23% growth potential. And this is also Google, with the same 23 growth potential, which means that only 2 stocks, Microsoft and Google, look undervalued based on our DCF equity valuation model. You can also use the stocks to buy iOS application. It has the screen with those forecasts where you can see what type of stock are you buying. Just input the stock ticker, then analyze it, and it will show you the stock growth potential based on the DCF valuation model. You can see how the app is called, how you can find it in App Store right now. And you can download this app from the App Store and see the stock growth potential. You don't have to input everything from this video manually. Just download the app and you're good to go. So this is how you can calculate the stock growth potential, the stock target price, using very popular DCF valuation model. Thank you very much for watching this video.